Let's go to David Wech, Chief Economist at Vortexa, sitting in Austria. David, it's not oil alone that is soft this morning, and obviously WTI, below $90 on the morning, 87.71. Brent still above $91. But we are also seeing in the case of agriculture, the prices of urea, one of the world's most important crop nutrients, is down 30% since mid-April. The Bloomberg Agricultural Spot Index, which tracks 10 of the world's most traded crops, falling to its lowest level since March 5th. Aluminium is down at a 1-month low. These are all of the sort of tangential pieces of this puzzle, of which obviously oil and gas is the main disrupted supply coming out of the Gulf, but all of the urea and the fertilizer and so on. All prices seem to be moving downward here, and yet this crisis remains. What's your sense of those pieces all together while we still have, military hot exchange in the Gulf?
Thank you for the surprise question. So
Well, it's a
I'm
macro sense of
yeah. No,
softening.
no, no. Don't worry, don't worry.
Yeah.
I look, I'm not an expert on the products you just mentioned, but I think what may be a play across commodities, across markets, is that evidently, in a way, this is the biggest supply crisis ever. It is technically, from a numbers perspective, in the oil market, but it's surely not in reality. Yeah. And the expectations that we will be in big troubles if this goes on for 4 months, yeah, have simply not realized. Yeah. I mean, that's, I think, a fact. Yeah. There is no sign, I don't see a sign that the global economy is collapsing, that the Chinese economy is collapsing, that consumer demand and confidence is collapsing. We are moving forward. Markets are supplied at this point of time. I think that's a crucial reason why prices are range bound, because there is actually no sign across the barrel. I mean, LPG in India is short, no question. But outside that, I'm not aware of a market that shows a clear physical shortage of anything related to the Middle East Gulf. And I think that's where we are pricing. Yeah. And
Is demand destruction a new word for shortage? I mean, India's fuel demand is down 6.5%, LPG consumption down 20%, the biggest LPG market in the
yeah,
world. I mean,
yeah,
there's no shortage because demand destruction is, I'm not cooking lunch today.
yeah. Um, First of all, demand is difficult to measure. Most demand measures are some type of delivered supply measures. Therefore, in the current environment, they will tend to show more impact than what is really going on. Yeah, because yes, of course, there's a problem with supply, for example, of LPG. India is also particularly exposed, but generally speaking, I'm simply not aware of significant amounts of gas stations around the world running dry, or retail prices going to levels where a huge chunk of people can't afford it anymore, or situations like this. Yeah, I stick to my claim. Overall, markets are well supplied, and the demand impact, the demand destruction, that's probably type of the biggest puzzle. You can see very diverging figures. Some figures are very high, and they're saying we have lost 5-6 million barrels per day of actual consumption. I doubt that. I think the loss is much less than that. But of course, there is a lasting impact. And one final thing really to say, the world, China in particular, but the world generally, of course, in 2026 is less dependent on oil than it was any time over the last, whatever it is, 50 years or so. That's simply because there is energy diversification and there is also energy localization. Yeah, so you can produce power in your house or in your village or whatever, in local settings. So the dependence on outside supply has generally decreased.
Regardless of all of this I mean, the reality is that inventories continue to fall. I mean, this is the, hard reality. There's no shortage, as you said. There's no queues at the gas station, whatever. But U.S. is reporting, inventories, API numbers out over 9 million barrels down at the end of week June 5. I mean, this at some point you go to the tank and there's nothing going to be there because these inventories continue to drop. Is this a race against time still?
Yeah, let me come back to that question. I
Yeah,
need to follow up on the previous question. As you
please.
know, we are ship tracking. So,
Yes.
yeah, there are more vessels coming out of the Gulf. But what has basically happened is that the Iranian crude flow has been replaced with a crude flow of a similar size from the UAE. Not so much Saudi. Kuwait is now back a bit. Iraq is back a bit. It's primarily the UAE that is doing a lot of this transit. So basically, the one thing I wanted to add there, the volumes are still overall as low as they have been in April, May. But it's now more mainstream barrels and much less Iranian barrels. And the people that are transiting the oil are primarily the exporting countries. It's not the consumers that are going in and taking the oil out from the Gulf. It's the exporting countries that are transiting the oil and that are then frequently doing STSs outside that region to the vessels from the consuming side,
So it's not
basically.
the independent traders, it's the
It,
national
it,
energy
it's the
companies.
national energy companies that are looking for ways to get the oil out. I mean, it's evidently, a big question for them,
A
and
guy
that
who
makes
knows a guy. I mean, come on, it's the ancient trading routes of
yes.
the desert.
It makes it also a bit more difficult, evidently, for the Iranians to target these players, yeah, because they also know that they're still at OPEC, and it's a type of partners they are, whether that's Iraq in particular, Kuwait, yeah. So that's I think what causes this leakage. The inventory question, of course, ultimately the answer is very clear. It's a race against time. However, the US can in theory run down the SPR for an entire year at the current rate, and China, the other crucial countries, can run stocks down still for quite a long period of time. So not as long. I mean, it depends where you go, but if you go back to the historical average levels, you can probably run another 2, 3, 4 months without any significant problems. So there is a buffer there. At the same time, I think what is very important to understand is that the stock draws from a global perspective have been relatively limited in outright terms. But if you compare it to the seasonal pattern in Q2 or to the pattern last year, then the figures become much higher. So the headline figure in our data is about 1.5 million draws from peak to low recently. But if you compare it to the seasonal average, it becomes 2.7 million barrels per day. And if you compare it to the pattern from last year, it becomes 3.5 million barrels per day. So what I want to say with that is Q2 is a low demand period, refining maintenance period. Now that we go into the peak period, the normal pattern is stock draws and not stock builds as we had over the last couple of months. Therefore, the stock draws will start to hurt more.
What about David? Just to finish off on that, I wanted to ask you about rates, tanker rates. The freight rates that had soared in the. I mean, all of these commodities are still elevated. They might have come off where they were peaked in March, April, but they're still at elevated levels. Where is that in the freight rates, and how does that filter through? What's the dislocation with tankers in all sorts of places that you wouldn't usually be?
Yeah, overall, I would say freight rates are still, from my point of view, surprisingly high. All this uncertainty, that's always, that is driving freight rates higher. There is the simple fact that overall less oil is flowing. Yeah, that's out of question. So that is not good overall for the shipping industry. But given all the uncertainty and also partly yes, changing and longer trade flows like crude from the US all over Asia, that is providing support. But at the margin, I would expect rather lower than higher freight rates down the line.